Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, January 6th in the new year of 2025, and I'm recording this from my office in Purchase, New York. Closing the books on 2024, many investors will likely remember two major themes that drove markets last year. One, the concentrated outperformance of the mega-cap generative AI names, which produced the so-called Magnificent Seven leadership. And two, the dominance of U.S. stocks versus other regions, embodying the narrative of American exceptionalism as a unique destination for innovation and economic growth. These dynamics helped drive the S&P 500 higher by more than 23% for the year, despite the fact that the Santa Claus rally failed to materialize in the month of December. Combined with a great 2023, the index capped its strongest two-year run since 1997-98. Those themes may be well understood by investors, but what may be less appreciated is the outsized role that liquidity and momentum played in last year's results. Specifically, the 12-month momentum factor delivered a staggering 58% return, outpacing other factors by at least 38 percentage points. When we think about momentum, it's a pure technical and sentiment-driven factor. It represents the ultimate form of trend following, a phenomenon that can both distort markets with regard to fundamentals and obscure relative opportunities. What's more, it can change suddenly, especially if non-fundamental dynamics like liquidity and financial conditions begin to shift. Consider that factor crowding into momentum distorts our understanding of the distribution of performance underneath the surface. In 2024, while the S&P 500 cap-weighted index gained 23% in aggregate, the average name in the index was up only about 13%, while the median stock was up not even 10%, and about a third of all stocks in the S&P 500 index were actually down. In addition, momentum-driven markets also foster valuation disconnects, as is currently the case. Forward PE multiples for the index have increased by more than 4 turns since October of 2022, accounting for nearly all of the 65% gain, even as earnings have grown only 7.6% over those past 2 years. In other words, index gains have come almost disproportionately from valuation expansion and belie a lackluster earnings picture. In this light, we take December's relatively weak performance of the momentum factor seriously as a potential harbinger of things to come in 2025. Consider that as interest rates rose, inflation expectations stopped falling, and the Fed policy expectations were recalibrated, financial conditions begin to tighten. Equities fell, and the momentum factor underperformed the overall index. Should momentum continue to fall, it signals to us that we may be entering a period when fundamentals matter again, and the trend of markets moving solely on anticipation is behind us. So with that in mind, we emphasize active investing over passive, quality and value over momentum. Policy dynamism is likely to produce new market leadership in 2025 when stock picking will be critical. In that vein, we favor financials, energy, residential real estate, and domestically focused manufacturers of industrials and branded consumer goods. Healthcare as a sector looks oversold. Longer-term investors should focus on rebalancing portfolios and maximizing diversification among stocks, bonds, real assets, hedge funds, and private investments. As always, thanks for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor. And again, Happy New Year.